Stephanie, the economy doesn't need below trend growth now for a soft landing to happen, you say. What does that mean for the Fed's flexibility on cuts?
Yeah, I mean, what we've seen is you can have strong growth and inflation that continues to moderate. So we're getting this non-inflationary growth, which is what we saw on Friday in the PCE report. PCE came in at 0.26%. The street was looking for 0.3%. And the surprise really was on the consumer side, which came in really quite robust. So we've seen these trends where the supply side of the economy continues to rebound, and that's allowed strong growth and inflation to continue to moderate. We very much believe that January was largely driven by seasonality, and the Fed is leaning on that too, which is why the Fed's likely to still be able to cut in June. We don't have to necessarily be scared of these stronger data points because inflation continues to remain really quite modest.
Okay, so Katerina, what does that mean for fixed income? I keep hearing that wealthy investors are looking to lock in these higher yields increasingly at longer durations.
Absolutely. John, rates are on the way down. Now, we might not know the timing, and we might be unable to predict whether Fed is going to have, 3 rate cuts this year or 2 rate cuts this year. But we know that rates are going towards, the lower points. So investors are taking in these opportunities to lock in higher rates, both on the municipal side and on the corporate side, and extend the duration because, let's face it, the 5% money market is something that we feels like has been around forever, but it's only been here for a short time frame. And we need to know that, this is something that's not going to last. So both on the stock side, when we need to take advantage of the buying opportunities, in the quality sector, the sectors of the market that didn't have the run up yet, and also some, decent amount of profit taking in the sectors and in individual positions that had big run up. And when our clients are asking us where should they allocate, these profit taking proceeds, we tell them take a look at the fixed income and take advantage of the higher rates.
I'm still not bored with 5%. It's still exciting to me. I don't know. Stephanie, the spending from the consumer continues to be such an important part of the picture here. But I don't know. I keep looking over at the debt levels and the defaults that are starting to pile up. But then the jobs picture is pretty strong. So does that sort of keep things in balance for the economy?
Yeah, as long as the job market remains firm, then the consumer will keep spending. They'll spend in line with their income growth, which is in a real term should be somewhere around 2 to 2.5%, and then the economy should hold up just fine. So you've started to see some pickup in delinquencies, but that shouldn't be an issue as long as the consumer is employed. And what we've seen so far is the labor market has been incredibly robust, and that should remain the case because company profit margins are really quite high. And there's no reasons for companies to do massive layoffs if their margins are quite healthy, and in which case the labor market should continue to be solid. The biggest expenses that companies have are capital spending and employment, and as long as their margins are healthy, they're going to keep spending on that, and we should see that throughout the course of this year.